Let's see. Right?
So hello everyone, welcome to our live stream on the PMS strategies. Uh, we have recently launched our PMS, which is a quant-based PMS unique for the Indian market. And in this video, in this webinar, we'll be talking all about the Wright PMS. Hello everyone, welcome to our live stream. We'll start by talking about, I give you a short presentation on the PMS strategy to begin with. Then we'll, quickly talk about little bit about the market, and then we'll go on to the Q&As that you guys have put on our previous live streams or into the form that you guys have put in, and then we'll do the audience question and answers, right? So let's start with the presentation. Okay. So you guys are aware that we've launched the PMS recently. And it is a very, very organic step for us. Why, we have been doing our investment advisory strategies for the last 4 years, right? Which have done increasingly well for our customers. Many of you must have subscribed, and I hope you are happy with what we have done. And we thought that, taking it out in a fund structure where we also get to manage the trading, manage the rebalancing, quickly apply risk management was a very, very organic step for us. And that's why we're very excited about what all we can do in the PMS setup, right? Now, the Wright PMS is based on all the quantitative methods that we have been doing in the investment advisory setup as well, what you have seen on small case. And I'm sure that you guys know about us. We've been doing this for 4 years. Our team has, some excellent people working for us. I come with a background of more than 10 years in quantitative research at these large organizations. We have grown our fund to more than 300 crores. Siddharth is here on the live stream, who is, an ISP grad who has, a wealth of experience in investment advisory and financial markets. We have 13 people working with our team who are super, super enthusiastic about this setup, right? All our strategies are based on these quantitative factors, right? From factor investing, momentum investing, market regime modeling, artificial intelligence-based, risk modeling, as well as efficient hedging. So I'll go in depth about these things in this video, and I'm sure a lot of you guys know about it. You've seen it in the previous video, but just a refresher on these topics, right? So the first thing is that, with Wright Research, we believe, and a lot of investors believe that, any portfolio is not just, the returns don't just come because of, a single person stock picking or, looking at companies on a standalone basis. We think that any portfolio, any stock can be broken down into a number of factors, right? So from the valuation of a stock to the growth that the stock is showing, to the quality that the stock has, to the momentum or the trend that the stock has, all of these factors influence prices of a stock. And if you can numerically model all these factors, you can get a good sense on, how the stock is going to perform. So if you might have read our recent blog, we talked about, which companies are giving good growth numbers based on the recent earning numbers, which valuations are not, stacking up. And, these things influence the market incredibly well, right? And we use this data-driven method to look at all these factors, right? So the data-driven approach that we have, we think it is extremely important because this creates an objective way of picking stocks, right? You're not just, you remove all the subjective biases. We don't overreact to any stock, numbers. We exit when needed, right? We don't hold on to stock because we bought it. We take objective decisions here, right? And the data set that we get to work with is very large and diverse, which I'll also talk about in this video. The speed of analysis is faster because, we are working in a data-driven fashion. Similarly, the risk management can be automated. The performance can be consistent and predictable, as in we know if the market shifts gear, what is going to happen with this particular strategy. Now, with Wright Research, we try to understand all the factors that influence a stock's return, right? So what are factors? Factors are anything that can drive outperformance in the stock. And there is no one thing that will drive outperformance. Sometimes, the valuation of the stock becomes very important. Sometimes the growth that the stock is showing becomes very important. Sometimes the quality that the stock has is extremely important, right? So you see different types of investors talking about different factors, right? And all of them are extremely important. We look at price momentum, and you guys must have seen our momentum strategy, right? And the power of momentum investing. So momentum is an incredibly important factor. We also look at different risk factors, liquidity, size. We look at analyst recommendations. So sometimes the analyst would rate a particular stock based on their analysis, and we look at the analyst recommendation on the EPS and the growth numbers to pick stocks as well. And we, like I said, we try to explore any numerical factor that can influence stock returns. So sometimes we look at sentiment, sometimes we look at ESG, and there's a lot of ongoing research that we do in identifying and using these factors, right? Now, like I said, that factors are a driver of long-term performance, right? So if you look at every factor in comparison with the Nifty, you will see that all of them have in fact done better than the Nifty in the long term, right? You can see momentum has done incredibly strong in India the last 10 years. Quality has done quite well. But any other factor from value to size to any macroeconomic factor, they have been identified in such a way that they do better than the market in the long term, right? But what is very important to note here is that not all factors will work all the time. Sometimes a factor like, momentum does incredibly well. So if you look at the past 4-5 months of data since March, momentum has done quite well, right? Similarly, in 2020-21, after the COVID crash, momentum picked up at a very, very rapid pace and gave you a very strong performance. But if you look at last year, right, when there was a lot of volatility, during those times, you would have observed that value might have done better than momentum, right? Moving to safer stocks or better instead of moving to slightly riskier stocks. So I think the holy grail of factor investing is picking which factor would perform in the current market, and that is what we try to do in the Wright PMS, right? So what we try to do is we try to understand what type of market we are in. And obviously, we can tell that what is the market today, right? Or what is the market in the last month. That is easy to say, right? But what will happen in the next period is extremely important, right? So what we try to do is we try to forecast what will be the risk in the next period. And that is where we use artificial intelligence methods, machine learning, and we look at macroeconomic data as well as some technical data to forecast how the market is going to look at in the next period, right? And based on the risk that is going to come into the market, we take our investment decisions, right? So again, it's all system driven, but what we tell the system is that, when the risk is low, when the market is going through a bull phase, then you can take as much risk as you want, right? And automatically momentum type factors start getting high allocation during those periods. But when the risk is high in the market, when there is volatility in the market, the model automatically reduces the risk that it can take. And when the model reduces the risk, some safer factors will come into play. You might see value coming in, you might see low volatility coming in. Sometimes you would even see gold and bonds getting some allocation in this strategy. So now with PMS, see, the minimum investment is 50 lakh because it is a SEBI mandate, right? So as per SEBI, we cannot, onboard a PMS investor until unless they put in 50 lakh here, and which is a constraint that we have to work with. This strategy sort of works on top 500 stocks on the universe. So a mix of large, mid, and small caps will compose in the strategy. The number of stocks here will be 20 to 30. So similar to what you've seen in our balanced or momentum strategies, 20 to 30 stocks will be there. We are sector agnostic. So, we don't say, we are going to invest in one sector or the other sector. It will be totally based on market conditions. Sometimes you will see, that in the last month, there was a lot of financials, there was a lot of capital goods. If the market changes, you will see different sectors will come into this strategy, right? And the stock allocation will also not be more than 10%. So, there will not be a lot of unsystematic risk or specific risk related to a company. So it all works through an optimization model where what is important is, obviously getting good returns, getting a lower risk, but also reducing the cost that we're incurring, right? Every time you trade, you end up paying a cost to your broker. Sometimes, when you trade, you don't get good prices. So all those costs sort of build up. So the idea here is that we want to be extremely tactical, take advantage of the opportunities, but again, we don't want to trade too much, right? So if you look at this chart, and this is updated till July, you will see that this strategy has done much better than the benchmark that we look at, right? So our benchmark is BSE 500 total return index. And as per the data in July, and this presentation is slightly updated, we see a 38.7% CAGR, right? Now, these numbers are all pre-cost, right? These numbers are not post-cost. So if you look at the broking cost and the management fee, you would let go of around 1% or slightly higher than that in terms of performance on a yearly basis. Secondly, if you will have to pay tax similar to how you pay tax on your equity holdings here, right? So on your equity holdings, you end up paying a 15% capital gain tax when you have a short-term holding period, right? Less than 1.5 years. But if you hold more than 1.5 years, you pay only 10% tax, which is long-term tax. In this strategy, majority of the holdings will be short-term, but there will be a few long-term holdings as well. And as a PMS, will provide you all the reports, all the numbers that you can go and use to file your taxes. What is very interesting in this strategy is that you can see that the return numbers look incredibly well, but the volatility is lower than the market, and drawdowns are also extremely low in comparison to the market, right? So I think that is where the power of the strategy comes in. In good markets, as you guys have seen, the momentum type strategies do extremely well, but when the markets have a little bit of risk, right? During those times, you will see that this strategy does very strong risk management and reduces your risk as well. So how are stocks picked in the strategy, right? That is an important question. So in any given market, we are looking at which factors to allocate to, right? And this totally depends on the market condition. Like I said, when the markets are good, we let the model take a lot of risk. But when the markets are risky, the model reduces its riskability and ends up giving allocation to slightly safer factors. So you would see gold and bonds also get some allocation in this model during risky times. And in extreme risk, right? We are all aware that markets sometimes go through extreme risk scenarios also. During those times, what we do is we end up deallocating from the strategy, moving a little bit into crash, not totally into crash. But what we do is let's say there's a 10% correction, we will reduce our equity allocation by 10%, with another 5%, we reduce 5% more. And we keep on doing that till the market recovers, right? And at that point, we start reallocating in a systematic fashion. So all the risk management methodologies, the diversification, the looking at all these uncorrelated factors brings strong risk management into this strategy. Now, talking about risk management, you can see here that the strategy has a similar risk or slightly lower risk in the market in most years, right? And if you look at the couple of risk scenarios that we put here, you will see that the strategy does much better than the market. During extreme risk scenarios, 2020, you can see the strategy only had 18% correction, which it quickly recovered from when the market corrected 30%, right? And similarly, last year, you can see this strategy has a better return than the market. We've also put yearly returns here. So as you can see, not every year will be giving you an incredible return, but the average return will look good in the long term. So you can see here the strategy has done incredibly well in 2014, 17, 2021, 2023 has been very good. But there have been years where the returns have been moderate as well. So what is very important here is that we need to understand that when we are investing into any investing strategy, we always should have a long-term horizon. So in this chart, I put in rolling returns of this strategy, right? So you can see while the 1 year rolling period has a lot of ups and downs, right? There might be few years where the returns are moderate, few years when the returns are incredibly good. As you move on to the 2-year horizon, you will see that the returns over 2 years look much better, right? And if you move on to the 3-year horizon, you will see that every 3-year period has a more than 20% CAGR. And recently, as we all know, after 2020 crash, there has been a very good growth in the market, which you can see through this 3-year return. And if we invest in for 5 years, you will see again the numbers are much better for 5-year horizons. So when you invest, always invest for the long term, and obviously every period's return will depend on the market horizon. So if you invested for the last 3 years, you would have received more than 50% plus CAGR, right? Which you have seen with our momentum strategies and other high performing strategies as well. But when you move on to years where there has been a lot of volatility, like 2018-19, you will see that the 3-year CAGR has been around 25%. So everything depends on the market, right? But the idea here is that always invest in the long term, always have a 3 to 5 year horizon when you are looking at a PMS, right? Now, another important factor here that this slide shows is that, while we have talked about CAGR being good and drawdowns being low, what is important is that, we are trading, and trading has a cost, which is very, very important for us to understand. When we look at discount brokers, we tend to miss out on the cost, right? Sometimes, your brokerage might be very minimal, but when you churn your portfolio, when you're trading, right, you end up paying a cost to the market itself, right? We wrote a blog post about it where, if you look at the order book, and if you're placing an order of 500 shares, your first level order book might have 10 shares, second level might have 20 shares, and you will end up getting a bad price if you go deeper into the order book, right? So those type of factors lead to high trading costs. That's why we keep turnover in this strategy low. Also, what we do is, in the PMS, we get to control the trading as well, right? So if you might have seen our small cases, and if you look at our PMS, the difference here is that because we control the trading, we don't send market orders. What we'll do is we'll slice the orders into, if I have to place a large order, I would not place one order, I would slice it into 200 to 300 sub orders that go over, let's say, 15 to 30 minutes period. Secondly, with the PMS, we have control of the trading. So let's say a risk scenario comes in, so we get to act faster in terms of it. We don't have to stick to a 1 month rebalance. So while we will not trade more than 20%, let's say, in a month, but we don't have to stick to the end of the month. We can take the calls as the market shifts, right? And any stock similar to most of our strategies will be held between 3 months to 3 years. Some of the stocks will have a long-term holding period, but a majority of them, like I said, will have a short-term holding period. Now, to give a brief about how PMS works, I think a lot of people might not have done PMS before. So let me talk you through how PMS works, right? So ours is a discretionary PMS, right? What a discretionary PMS means is that we get to trade on your behalf. We will get a power of attorney on your brokerage, on your demat account, right? And what we do is we trade on a pool level, right? So if I have 10 customers, I can trade for all 10 of them through one, trading terminal, right? Through one demat account. But at the end of the day, all of the securities that were traded for you go into your demat account, right? And this is all managed in the backend by a custodian and a fund accountant. Now, for the custodian and the fund accountant to sort of allocate your shares to your trading account, what they have to, what has to happen is the PMS and you have to have the same demat account, right, with the same custodian. So that is why we have to open a custodian account for you. And that is with Edelweiss, which is now renamed to Nuvama, uh, that we are working with, right? So the process would be that we open a demat account, you sign a power of attorney, you sign an agreement. This is a little bit of paperwork right now, but we're looking at digital solutions also. So starting with, we'll just collect some of your documents via email. We'll prepare all the forms and we'll courier it to you. You send it back to us, and if the forms are good, your investment account is open in 2 to 3 days, right? Which is when you start trading, which is when we can start trading. But again, we are not given access to these accounts until unless those accounts have 50 lakh in it. It's just because it's a regulation. So that is something to keep in mind. Now to talk a little bit about what are the charges, right? So like I said, the charges, there is a broker, there is a custodian who will take a slight fee. So the broker that we have right now has a 10 basis point fee. This is Edelweiss, but we are also exploring other brokers. Like I said, some of the discount brokers, give us slightly lower fees, and we are sort of in the process of impaneling with them. But, there is no zero cost broker for a PMS. So we will still have a slight charge on the broking side. Custodian and demat, which I told you, which handles the backend and handles the allocation for the clients, takes a 5 basis point fee on an annual basis, only on the capital, not on the trading. And then we have no other charges. There's no entry exit charges. There's no holding period that is strictly enforced. And if there is a need for any client to get the statements audited, then you can pay a slight audit fee and get that done. But we will not be charging anything extra apart from this. And we give you an access to a portal where you can track and see all your positions and trades on a daily basis. But this is updated at the end of the day, and you can download all the reports, your trading, PNL, etc., similar to what happens in your broker, and take them to your tax consultant, right? Now, talking about our fund management fee, we have 3 types of fee which are very, very competitive if you look at the PMS market. In the first structure, we only offer a flat fee, which is 1%, right? And this can be charged on a monthly, quarterly, half yearly, or yearly basis as per the client. In the second structure, we don't have any fixed fee. We only have a variable fee. What that means is that, and there's a hurdle, right? So let's say the hurdle is 10%. So anytime the PMS does better than 10% in a given year, so let's say the PMS does 17%, right? So you will pay us 10% of the difference between 10 and 17, which is 7. So you will end up paying us 0.7%. In the third structure, the hurdle is not fixed. The hurdle is BSE 500. So anytime the PMS does better than the BSE 500, you will give us 10% of the outperformance as a fee. So all of these are very interesting structures. In structure 2 and 3, you don't pay us until unless we do better than the market or your expectations. In structure 1, you end up giving us just a flat fee. But if you look at some of the numbers that I've shown you, you can see that the PMS in fact does better than 10% in most years, and sometimes the returns are exceptionally well. So the fixed fee in structure might end up doing better for you in the long term, right? In terms of overall cost. So that is all about the fee structure. If you look at the holdings, these are June holdings. These are not current holdings. In June, we had a lot of financials, capital goods, pharmaceuticals, and our top holdings are also shown here. This allocation obviously shifts as the market shifts, like you must have seen in our other strategies as well. And we can quickly talk a little bit about the market as it goes. And like I'm saying that, all of our strategies, our PMS, we have onboarded quite a few clients, but it is a fresh PMS, right? It is just starting. So there is no actual numbers to show you. There are only a few days of actuals, but in fact, we don't have these long-term performance to show you, but, you can compare this with some of our small cases like a multi-factor, which has given more than 30% CAGR in the last 4 years, our momentum, which has again given 47% CAGR in the last 3.5 years. So, that gives us a lot of confidence that, we will be able to replicate the performance of the backtest in this setup as well. And we are very excited about that. Now, for you to, if you are interested and if you want to reach out for the PMS, what you have to do is, you can email us if you want to, info@wrightresearch.in, reach out to our customer support, or a very easy way is you get to go to our PMS website, right? Which is this. And if you're interested, you can quickly just drop your details in one of our fund pages on the main page. So you'll see a link like this where you can put in your email and phone number. If you've given us an email, I'll send you a link where we can set up a one call if you want, where we can answer all your queries. Or, if you give us your phone number, somebody will call you and set up that call with you, right? So that's a very quick and easy way to get you started on the PMS. We can quickly talk a little bit about the markets, if that's fine. So we posted a blog recently about the Q1 FY24 earnings, right? And what this tells us is that, in the broader picture, the corporate earnings have decreased a little bit in this earnings season, whereas margins have been very good. And while the margins, so until unless these companies can expand on the revenue numbers, we have to be very careful about the market. Now, the themes that have been, I'll talk about some of the themes that have been doing well. So the consumption theme has seen some bit of a drawdown, but with the good monsoon, we see consumption being stronger. So FMCG sector, auto sector might end up being strong in the next quarter. Similarly, if you look at IT, pharma, these sectors are having a resurgence, and we expect them to do well in the next quarter. In terms of commodity, oil marketing companies and the commodity sector has been going through a pressure, and that might continue for some time. In terms of financials, the numbers have been quite strong, but they might moderate in the next period, right? There's no, sharp decline that's going to come, but the numbers might moderate in the next period. In terms of industrials, again, the performance has been very strong, but, there might be, due to the global scenario, there might be supply and demand issues that we have to be careful about, right? So a lot of interesting things happening in the market. And with the slight correction that has happened in the market, there will be a opportunity for us to rebalance our portfolios, to churn the sectors, to relook at a sector allocation, and we are well prepared for it. So that is pretty much it about my presentation. Siddharth, let's start with some of the audience questions.
Yeah, sure, Sonam. So just to sort of set the tone here, where we have a bunch of questions that we had circulated out in a form. Mm-hmm. Sorry, can you hear me?
Yeah, sorry.
Okay, great. So we had circulated a form, and I think we've got a bunch of questions. We've sort of allocated them into, I think, 16, 17 different buckets. So we'll go through that first, and then we'll maybe answer a lot of the questions that we're getting on the YouTube live as well, right? So the first question, I suppose, is more related to the administrative and the sort of very basics of PMS, right? So this is a question by Mr. Avinash Chandra. He's asking, do we plan to change the minimum amount for PMS? The answer here is that we can't change the minimum amount. It is 50 lakhs, and that's something that SEBI has sort of set up, right? But if you want to sort of add anything to that, happy to sort of hear your thoughts, or we can sort of move to the next question.
Yeah, I think the 50 lakh is something that we have to work with. That is a SEBI mandate, and we, like I said, we don't get access to your account until it has 50 lakhs. I think this limit used to be 25 lakhs around 2017-18, but SEBI has increased it, and we hope that they work in favor of the investors in the future. But this is the limit that they have right now.
Correct. And so I think there's another question that we have again from on the basic part, which is from Mr. Sanjay Kumar. So he's got two parts here. The first is there any way that they can use their existing DMAT account for PMS? And a follow-up of that is, if they want to sort of join the PMS, for people who are not based out of Bombay or Mumbai, how can they sort of go about it? If you can just sort of share some thoughts on that.
Right. So see, like I said, that we have a pool account and your account, and we have to efficiently manage the allocation between the two, right? So for that, you and me, both of us have to be on the same custodian, right? So if you have an existing Edelweiss account, then you can convert that into a PMS account. But if you don't have a Edelweiss account, then you will have to open a demat account with Edelweiss. Now, what is important to understand here is that the broker, right, that the broker that we work with, the person who is enabling the trade, is not linked to your demat account. It is just linked to the pool demat account, and we don't have a constraint to work with one broker. We can add as many broking accounts on brokers on the PMS level, right? So we can, so like right now we are Edelweiss, we can add Zerodha, we can add other brokers who might give us better services, right? So that is something that we are obviously working on. But yes, the demat has to be opened with our custodian. Now, the second question that he asked was, if you're not based in Mumbai, then how does it work? See, I mean, you can invest in this from anywhere, right? So even NRIs invest in this. So if you want to invest, like I said, the process is that we just take your basic information, basic KYC information via an email. We prepare all the forms and we courier it, right? So if you are in Delhi, if you're in Bangalore, if you're in anywhere in the country, so we've had people investing from very, very diverse places till now. We just courier it. It takes a couple of days to reach you. You sign at the form and you send it back to us. And that's the whole process. So you don't have to be in Mumbai to invest in the PMS.
Got it. And so I think you mentioned about NRIs, and this is probably coming up in the later section, but probably we can mention it now. So obviously PMS is available for NRIs. There's a question here from Mr. Srinivas, who's asking, what is more advantageous for a resident PMS, or is it an NRE PMS through PIS? So if you can shed any thoughts on that, yeah.
Yeah. So let me explain to you the NRI thing, right? So for NRIs, we cannot pool your funds, right? So like for domestic clients, we'll have a pool account through which we operate, but for NRIs, that is not allowed, right? As per the banking mandate. So what will happen is we'll open a demat account for you. We'll link it to your bank account, right? So you will have a NRE PIS account, a bank account, as well as a demat account with Edelweiss, and you will give us power of attorney on both of these, right? And we can, we'll just trade, and the trade will be linked to your own bank account as well as demat account, right? So it will not go through the pool structure. But if you talk in terms of paperwork might be easier for domestic clients, but NRE PIS is not that complicated, right? We prepare everything and send off the forms to you. Right now, the custodian that we're working with works with HDFC bank accounts as well as IndusInd bank accounts. So if you have and with HDFC, what happens is, why it's very interesting is that, let's say you have an existing bank account with HDFC, you can just open a PIS extension, right? And you don't have to give us power of attorney on your whole account. You have this extension account where you can give us your power of attorney. And I think that's it. But some NRIs do have preference for other banks in India. So we are actually in talks with another custodian who supports other banks for NRIs as well. So we are focused on working with NRIs. We see a lot of interest coming from NRI investors. So, we are handling that as well.
Got it. And so I think, so we'll move on to the next section, which is something that we've got a lot of questions about, which is primarily when the sort of comparison between small case that we have sort of got and the PMS service that we're sort of launching right now. Right. So this is a question that we've got, and then we'll try and go by line, and we may sort of skip some of these points. But broadly speaking, we've got a question here from Mr. Dharam Kumar, Senthil, and Yogesh, where they're asking how will the PMS offering be be different from the small case offering, and if you can identify, let's say, multi-factor portfolio or a momentum portfolio, how would those sort of differ as well?
Right. So, see, there will be, the methodology that we're following, right, like we talked about, are quite similar to what you must have heard on the small case advisory side as well. So the methodology sort of remains the same, the data remains the same. So there would be, no quality difference between these two strategies, right? There will be full focus on both of these structures, right? But the PMS right now has, if you look at the stock allocation, it has a very slight overlap with our portfolio that are live right now. So there will be that differentiation. See, what happens with the PMS is that I know there are two types of customers, right? One type of client loves doing the rebalancing, loves seeing the stock that are coming in and out from the portfolio. But there is another type of investor who doesn't want to do that rebalancing on itself. They are happier if somebody manages that for them, right? So for those type of investors who have larger capital and who don't want to rebalance, I think PMS is a good structure. Secondly, a difference in the PMS that would happen to that is that with PMS we get to control the trading. So like I said, we can use execution algorithms and optimize the cost of trading here, right? In terms of our execution. Secondly, if let's say a risk event occurs or if something drastic occurs, we can act quickly here. Similarly, we don't have to wait till the end of the month to rebalance. We can act as it goes, right? So I think those will be a few differentiation points. But what is very important to note here is that any advisory investor or any small case investor does not necessarily has to go to PMS, right? I think both of these structures are extremely interesting. Small case, you guys have seen that the returns have been good. So you don't necessarily need to move to a PMS unless you think that's a better strategy for you. So I think that is something very, very important to note here.
Got it. And so I think a natural follow-up here will be, okay, there is obviously a clear difference between, what we're offering from a PMS perspective and from a small case perspective, but maybe from a mutual fund perspective, is there any fundamental difference and how does it really sort of differ? This is a question that Mr. Sanjay Kumar has asked us.
He's asking the difference between PMS and mutual fund, right?
Yeah.
So I think, a mutual fund has a totally different structure, right? So they don't need to have a custodian and sub accounts. They just pool your funds, trade on it, and they just give you a unit of the mutual fund, right? That you hold on for a long time, right?
Yep.
Also in mutual funds, if you hold a fund for more than 1.5 years, you end up paying a long-term capital gain tax, even though the fund might be trading within those 1.5 years within the fund, right? So those do not impact the taxation. So those are the key differences. Secondly, if you look at mutual funds, if you look at the type of mutual fund that are there, large caps, small caps, and flexi cap, all of them have different sort of constraints put on them, right? They say, you can only have these many large caps, you can only have this much tracking error, this and that. So with the PMS, we don't have those constraints. So that enables us to take advantage of the opportunities in an active fashion, right? So I think that gives an advantage to the PMS.
Got it. And so we've obviously got these, I think about 10, 12 different small cases listed on our website and on small case as well. And naturally, we have our own mutual fund basket, etc. as well. So there is a question here from Mr. Akshay where he's asking, one, obviously, if PMS will come on small case, which is obviously no, that can't happen. But the next question that he has, which might be interesting, is that given that we have, a PMS basket, a mutual fund basket, and so many small cases, do we feel that there might be slippage in the PMS execution and ultimately it might lose its edge because there are so many different things that are happening right now?
So I think, if you look at our systems, they are well equipped to manage all of these portfolios, right? We have a very strong team who's looking at all of this. We have very robust systems, right? We have very good setup on the cloud, which is well backed up, and there is no difference here. On the PMS execution side, we are adding somebody for the trading in the team as well. Mm-hmm. And there will be a good focus on managing both the structures efficiently, right? So Siddharth, sort of has come for the small case and advisory setup, right? Even on the PMS setup, we are adding people to manage them efficiently. So I don't think there would be any challenges, and we are working on removing any sort of bottlenecks that might be there, right? So we are simplifying a lot within both these structures.
Absolutely, I think the team is growing pretty strongly right now. I think we're definitely adding more people. In terms of, so I think this is probably the last question we have in this bucket, which is that, let's say if someone has 50 lakhs, right? And they want to, they may have been investing in some of our small cases, Momentum, New India, Alpha Prime, etc. So what is the thought process behind, should they be investing, that 50 lakhs across these different small cases, or should they put it into, let's say, the PMS that we're launching? From a risk reward perspective, from a fee structure perspective, what is the thought process there?
Right. So, if you are investing into 5 small cases, then your fee might be similar to what we are offering on the PMS side, because you're paying that fee. But yes, see, one thing that I would repeat again is that, if you are investing by a small case and you're able to efficiently manage it, right, rebalancing it all is going smoothly for you, right, and you enjoy that process, there's no need for you to move to PMS, right? Only if you want to, if you think that the PMS structure might sound better for you because, you're not efficiently able to manage the small case, right? Only then you should come and join the PMS. And certain people have other preferences for PMSs, right? So that is, their preference. But I would not recommend anybody who is doing a small case and that automatically switch to PMS. That is not what we are saying. We have opened this structure, which is slightly interesting, which has, which can be useful for a certain set of clients, but not everybody sort of needs to move to that structure. In terms of risk reward perspective, a PMS might be, if you have 5 small cases, then you might end up having, 50 odd stocks in your portfolio, right? So in terms of that, the PMS might be, it might have only 20 to 30 stocks, right? So it might have a better risk reward ratio. In that sense, if you're doing a large portfolio, I think that would be one differentiation. And, there is no need, like I said, for people to move from small case to this.
Got it. Great. So I think we can move to the next part here, where I think there's a few questions I've seen on the chat and we've got on the email as well, which are related to the portfolio specifically that we have within the PMS context, right? And this is from Jinal on behalf of Komal, where they're asking essentially, is the weightages or the stock constituents between the factor fund and the factor hedge fund, are they going to be different? Are they going to be the same? What is the fundamental difference between the hedging and the non-hedging part of it?
Right.
And if, there'll be any positions in the non-hedge portfolio that will be taken in terms of bonds or in terms of goals, what is the sort of allocation that you're thinking there? If you can shed any light there, that'd be great.
Right. So on the hedge version, we will not deallocate to bond and gold, right? We will be in equities most of the time. That will be one differentiation. Secondly, there might be deallocation in both the strategies when there is risk, but in the hedged version, we'll also hedge it with the puts, right? In the
Good options, yeah.
Yeah. So we are going to hedge in the hedge fund. Now, in this, the difference, the allocations might be closely linked, but there is some difference between the two. But what I recommend to the clients that I talk to, Siddharth, is that, if you don't have experience with hedging, right? And also the hedge strategy is starting fresh, right? You've seen strategies similar to the factor fund on small case at various places for 4 years, but the hedging part of it would be new and not tested in the live market for you, right? So if you're not very sure about it, start with the hedge version, and as it goes, you watch that performance for some time, and if you want to switch over to the hedge version, that should be much more interesting. The benefit of hedging, obviously, is that it protects from the downside risk, right?
Yeah.
And it might be beneficial when the markets are volatile.
Got it. And so just to sort of ask another follow-up question, I think this is a question we've got in the live chat from Akashdeep Verma, where he's asking, in these sort of PMS portfolios, will we also focus on stocks which are in the F&O category due to hedging, or will it just be the cash stocks that we'll be looking at?
So right now, Akashdeep, we are looking at Nifty to hedge the portfolio, Nifty put options. We're not going to specific F&O stocks, because what happens is that some of these stock options tend to be extremely illiquid, right? So there is that there might be some issues like that come up, right? If you have an illiquid stock option, you might not be able to roll it over. You might not be able to trade it efficiently. The price might move very rapidly. So we are sticking to Nifty-based hedging right now, and we've seen and backtested that provides efficient hedge. In the future, if we evolve and include stock-based hedges, then we'll inform you. We'll let you know on how we are doing that. Right? So we do have plans on using stock F&O thing in the future, but we will inform you with due time and work with that.
Got it. So I think this is probably a good transition to the next phase of the sort of Q&A here. where we had a big section coming in for rebalancing as well, right? And that's a pretty important topic from a small case perspective, but maybe we can sort of deep dive into it from the PMS perspective as well. So I think the first question we have here is from Mr. Srinivas again, where he's asked, for small cases, we typically were following a monthly rebalancing cycle where if a bad news was coming, we sort of, in those scenarios, we might sort of act faster, but typically it's that monthly cycle, right? So here he's asking again, would we provide, again, would the rebalancing or the updates on the stock be occurring at a much faster pace? What is the sort of thought process and the strategy behind the rebalancing of the
Right. So Siddharth, here the thing is that with small case, the rebalance goes to thousands of people. So we have to follow a schedule, right? It has to go on the first of the month. People have to know when they expect it. If there is a risk event, we act in the middle of the month, right? If there is opportunity for that. So, but on the PMS, we get to trade with a terminal. We don't have to ask permission from the client, right? So, but yeah, see, one thing is very important, that we will not trade more than 20-30% in a given month, right? But if we have to trade the 20-30%, we don't need to follow that monthly schedule. We can trade in the middle of the month as well, right? So that is what the plan is here.
Got it. And in terms of, so let's say, obviously the execution is in our hands and we'll be able to sort of dictate as and when we need to in terms of rebalancing the portfolios and sort of making sure everything's running smoothly. In the current scenario, when the markets were reaching that sort of all-time high, there is a question here again from Jinal on behalf of Komal, where they're asking, what is it that they should be considering and whether it's the right time to sort of invest into a PMS type of structure.
Right. So I think, if you look at the current scenario right now, you would see that there has been a little bit of correction in the Nifty. The long-term projections and expectations across the market remain very robust, right? People are expecting India to grow at a rapid pace. In the long term, that story might be strong, right? But there might be any short-term correction that might come here and there, right? People are looking at valuations, people are looking at growth numbers, people are looking at revenue numbers that we talked about, which have not come very strong in the last quarter. It will depend on the numbers that are coming out from these stocks. And in any case, I think, when one sector comes under pressure, there might be other sector that gets into flavor, right? So if you look at the markets right now, your pharma, your cement, your IT are at an absolute bottom, right? And it seems like they don't have an opportunity to go down any further. The path for them looks up in the future, right? So depending on that, the PMS will churn the allocations, even though certain stocks and sectors might correct, there might be other stock sectors and factors that will start doing much better in the future, right? So I think if you look at the long-term path, right, next year, Siddharth, you'll see interest rates being cut in the US. That will be a big liquidity boost into the global economy, right? So those things will be extremely strong. If you look in terms of risk, in India, we are looking at global scenario and seeing some pressure there in the supply demand. And with China, there's an election coming into India, so there might be issues like that. But ups and downs are part of the process. We are not going to give you 10% fund every month. It will be a journey, but I think the long-term prospects look extremely interesting.
No, absolutely. And I think we'd also, I think we as a company and individually as well probably are very bullish on India and the overall growth story here. And coincidentally, we just released an article on that as well, I think on Thursday. So for those of you, you can check that out as well. In terms of, I think, so there is obviously a transaction cost that's associated with these sort of rebalances and the overall frequency of the rebalances that might be occurring, right? So that is probably the next question or the next category that I sort of move on to, which is this fee structure, where again, we've got both Sanjay and Jinal and Aditya asking these sort of very broad questions where, regarding the, let's say, the operation cost that's involved in managing the PMS, the transaction costs that are involved, and the overall sort of churn that will happen in the portfolio. So can you shed any light in terms of, and maybe sort of break down the overall, the basis point, the number that you sort of come up with into the different components that are there? I think that's also a question that we saw on the chat. So just any
so like you said, that, the churn would be to 50%, right? 250% with the 10 basis point would take away 0.25% from the strategy, right? Similarly, the 5 basis point on the custody fund accounting will take away 0.05% from the strategy. So operational cost will take away 0.3%. But we are also looking, like I said, we are looking at discount brokers. Who can give us lower broking fees. And we can add as many brokers as we want. We don't have to go back to the client to do any registration for it. On the PMS level, we can add these brokers. So we're looking at optimizing and reducing those costs as well. That is 0.3% to that. And then our fixed fee is 1%. We've given a lot of discounts, but that will, again, we crossed the 50 number threshold with our clients, but we'll be offering discounts, I think, till we cross the number of 100 clients on this strategy. If you're looking to start and you want to get those discounts, I think right now is a good time for you to avail that. So see, so there's a 1% fixed cost that would happen in the fixed fee structure. If you go for a variable structure, right, then you have to understand that if we do extremely well compared to the market, then you will end up paying a slightly higher percentage of it. So like in the presentation, I showed you that there is a 38% expected CAGR. Let's say that happens, right? And that is 28% over the 10% variable hurdle, right? So you will end up paying 2.8% in the long term based on that calculation. If you use BSE 500 as a hurdle, then with the 14% as a benchmark, right, as the hurdle, which we saw in the presentation, you will end up paying 2.4% roughly as our cost. So you have to work and optimize on which fee structure you want to go with, and these will roughly be the cost, right? So if I remove, let's say, 1.3% from the strategy, right? So
Yep.
in that case, it comes to roughly, let's say 36%. And from that 36%, you will have to pay a 15% tax. So you will roughly have a 30 to 31% compounding in the long term.
Got it. And in terms of, let's say, so we're getting a bunch of questions, guys. We'll try and answer them as well as in when we go through the different structures here. So let me just sort of continue on in terms of the fee structure. There's a question here in terms of the cost of subscription from Jinal and Sanjay, where they're asking, will the cost of subscription be charged from the fixed date, from the date of the contract that when it gets signed, or will there be a clause of increasing between when the contract is signed and when the actual execution happens? And in terms of the way the fund is or the expenses will be charged to them, will that be done on a monthly basis within the sort of commission and the hurdle rates, etc., that are involved in the entire process?
Yeah. So see, I think after you fill the forms and we get it and we send it to the custodian, it takes 2 to 3 days for your account to open. But your PMS account is activated only when you put in the funds, right? So the fee will be charged after you have put in the funds, right? So you put in, let's say, 50 lakh, only then will the charges start, and it will be from the day the account has been activated, right? Mm-hmm. And now once your account is activated, you can choose, right? So we are giving that option to the client that do you want a quarterly billing, do you want a half yearly billing, or do you want a yearly billing? You let us know. So fixed fee rate is very simple. On a quarterly basis, we are charging 0.25%, right? Which is 1/4 of 1%. But on the variable fee, what will happen is we will now, if there's a 10% hurdle, then we'll compare your performance with 2.5%. If it is better than that 2.5%, then we will charge you the performance fee on a quarterly basis. So that is again your choice. And, we are, so that is very important for people who are giving us the money to manage, right? That we are in close contact with them.
Yep.
So yeah, so our team will be in contact with people who are investing, and we'll work on any other issues, or if you don't understand anything, or you might have signed something but you want to modify and work with something, we'll be there for you. We'll be helping you in every step of the way. Mm-hmm. Secondly, I think that's pretty much it, right? That's pretty much it about the costing.
Got it. And just to sort of wrap up, let's say the fee structure with this sort of last question here, maybe there was a question here where they're asking if there is an option for again, this is from Sanjay Kumar, where he's asking if there's an option to change the fee structure in the future. If so, how frequently would that happen? And again, any sort of light in terms of what is better in a bull or a bear market, or if the market is sideways in terms
Right. So see, there is the option for you to change your structure, right?
Mhm.
Like let's say you've gone with a fixed fee, but you want to change to a variable fee, that we can change for you, right? As and when you inform us, right? After maybe the next cycle of the billing. But the structure that we are starting the client with, we will not revise it at least for our initial set of clients, right?
Yeah.
So we are offering discounts, so discounts are not going to go away in the future for those clients. If and when we revise the pricing, that will be applicable for the new set of clients. And as people know, we are a new PMS, we are very tiny, and people who are coming us are giving us the power to do well in the market. So charging a high fee from them is not a priority for us. Doing well for them, building their trust is most important. And maybe after we reach a certain threshold of clients, I think so that a certain threshold of AUM with this structure, we will standardize the fee, right?
Got it. No, absolutely. And I think that standardization will obviously naturally just happen as and when the scale sort of grows up, obviously. So just a quick thing here. I'll try and take some of two questions maybe from the chat right now that I've seen are quite interesting. One is from Mr. Santosh and another is from Mr. Tyagarajan. So the first question from Mr. Santosh is in terms of, let's say if the PMS account has a balance of 50 lakhs, and if the market goes for a correction and this goes down to, let's say, 45 lakhs within a month, do they need to fund that 5 lakh that sort of drop that's happened in the PMS portfolio? And on the flip side, if it goes to 60 lakhs, do they have the option to sort of withdraw it? So it's an
Yes.
exit reload question.
That's why I checked that with the custodians, and what they told me is that the client cannot withdraw money from 50 lakhs, right? If they, they have to maintain 50 lakhs into the account, but if the 50 lakhs goes to 60 lakhs, then you can withdraw that 10 lakhs. There's nobody stopping you, right? As and when you want. But if the PMS corrects, right, so that from 50 to let's say 47, right?
Yeah.
So during that time, we know that we can bring it back up, right? So you don't have to fund that account. That's a natural thing that has happened to the money, and with the PMS as it goes, we'll bring back the money. So for that, we don't ask you to fund that account, right? So any drawdown that happens organically, you don't need to fund it.
Got it. And let's say, so this is a question from Mr. Tyagarajan, where he's asking, just going back again to the puts and the sort of the hedged portfolio that we had, will we trade with put options too for extra returns, since his existing PMS doesn't sort of use any options for extra returns? So if you can shed light into why that is a good strategy.
So we are not using put option for leverage, right? So we will not be buying we're not buying call options, right? To take a leverage return out of the strategy. What we are doing is we are just hedging using put options. So let's say the market corrects, right? There is a downside risk, right? So how do you reduce the side risk? You buy on the short side, right? So if the market goes down, the put options value will increase. And that is the only strategy where we are using this put option. So if the market corrects and there is a downside risk, then we buy put options that can support the strategy on the downside.
Got it. And again, just sort of sticking on to the fee structure point, maybe this is probably the last question we'll take on this before we sort of move forward. There's a question by Mr. Himanshu Boyar where he's asking, so he's asking the similar sort of question, can he sort of change the frequency of the fee structure? I think that we've already addressed, Mr. Himanshu, you can sort of go back and check that. In terms of if he wants to allocate, let's say 50% to factor fund, 30% to alpha prime and 20% to debt, is there something that we are customizing for that, or is that just obviously just going to follow in terms of the individual cost structure that will be involved for each of these components?
Right. So yeah, we can definitely do that. The 50 lakh is only on the aggregate level. You can tell us how you want to allocate, or we can have a discussion on how you can allocate. We are in fact offering alpha prime for a few of our customers within the PMS structures also. So you can say, give me this much allocation to alpha prime, this much allocation to factor fund, this one allocation to hedge. What we are also doing is that specific to any client, right, who I see that shouldn't be taking too much risk. Let's say from investing through their company, right? So what we suggest them is, we'll reduce the risk for you. So what we'll do is we'll include debt or gold bonds in there to reduce their risk, right? So we can customize that as per the client.
Got it. Got it. So let's move on to the next part where we're sort of talking about, which is probably a lot more interesting for many people here, which is the returns and the back-tested, results of our PMS as well. So let's start with the returns first. There's a question here from Mr. Komal, where they've asked, if the drawdown, the Sharpe ratio, and the returns are somewhat similar for the two portfolios, the factor fund and the factor hedged portfolio. Do you see the hedged being a better option for people that are obviously, aware of the derivatives and the sort of F&O category?
Yeah, I would say that people who are aware of derivatives, you can go for the hedge version, because the hedge version is protecting you from the downside risk. In the long term, the hedge version might have slightly better return than the portfolio, and the drawdown seem to be similar, right? But in the downside, like, so if you look at the chart of the hedged and the chart of the factor one, you will see that the chart for hedged is slightly more smoother, right?
Mm-hmm.
So which might give you a little bit more peace of mind during volatile times. But don't go for a hedge version until unless you understand that we are using derivatives which have leverage and things like that.
Got it. Got it. And in terms of the PMS backtested results, this is a question that we've got many times, I think, through the calls that we attend, and also in these sort of live chats and discussions. So here's a question again from Mr. Sanjay, where he's asking if we can share any backtested results for the 2008 financial crisis during the demonetization period.
Right.
In 2018 to 2020, again, momentum wasn't a good factor. So during that period also, and maybe even COVID as well, I think, right? So if you can shed any light there, that'll be great.
Yeah. So we are so in the latest version of the presentation that will go out on the website. As you saw that we've added rolling returns also, which covers everything from 2014 to now. We have actually worked on the data from 2003 to now as well, Siddharth. We are also planning on incorporating that, because a few people do have questions, like what happened in 2008, what happens in other scenarios. So we are in the next presentation that will go out on the website. You would see all of those data points will also come in, right?
Yeah. All right. And in terms of, so I think, that's broadly most of the backtested results. I think what people can do is probably just go to the website and check out the PPT when it's up, and they can sort of jump into the nitty-gritty.
We'll also update the website data and the PPT both with these numbers.
Got it. This is a question in terms of how people can sort of allocate that 50 lakhs. Not everyone will put in cash, right? It could go in the form of mutual funds. It can go in the form of stocks. So if you can shed some light into that in terms of how that process would work, and if it's a new demat account, what are the sort of technicalities that people might need to be aware of? Again, this is a question from Jinal here.
So see, in terms of the demat account, it's similar to any demat account that you might have, right? And we will give you an access to a fund accounting portal where you will see all your holdings, all your cash and everything at one place, updated on a daily basis. So today, at the end of the day, you will see everything that is there in your account based on today's trading as well. So that process is extremely simple. The other question, so that was about what was the first part of the question, sir?
It was about, if you have, let's say, cash, mutual fund, stocks, etc.
So, transferring cash is the easiest way. It happens within a few hours. That's simple to start. If you want to transfer mutual funds or your cash or your stocks, right, then that is a slightly more involved process. So what happens is, see, you might have seen that transferring stocks from Angel to Zerodha is enabled online, because both of them are on the depository CDSL, right? So CDSL to CDSL, there is an online process to transfer. Sometimes that also has issues with that website. But Edelweiss is on NSDL depository, right? So if you want to transfer from CDSL to NSDL, then that process is slightly involved. So either you get a digital signature e-token, right, which you can use to do digital transfer, but you will have to register that digital signature with your broker first to sending them a letter, right? And a simpler way is to do the paperwork. So what you will have to do is, let's say you are working with a broker, what you'll have to do is tell them to give me a DIS slip, a physical slip, where I can fill what has to be transferred, which some of our clients have already done. Right. So once you receive the slip, you fill in all the details, you submit it back by sending a courier to your broker. And that's how the process works. Obviously, if you are doing transfers, it can become a little, it might be, a week extra for that process to come in. What we recommend is, if you really want to transfer stocks, you inform us as the paperwork starts, right? So that we can start that process of getting the slips at least. You'll be able to fill the slip only when you have your demat account, right? But we can start the process of acquiring the DIS slip right when the paperwork starts, right? That's the best way to go about it.
No, absolutely. And I think something that we also do probably is if people are unsure about what all they want to sort of push into this sort of 50 lakh category, we also sort of can do a overall review of the portfolio.
Yeah, we do that. We've done that for a few clients. Another interesting thing here is that, if your portfolio is different from the PMS portfolio, there are no overlaps, right? So we will end up selling those holdings to participate in the PMS, right? So that
absolutely.
In that case, it might be better for them to sell in the broking account itself, avoid all this hassle. And, the discount broker that you're working with will charge you less when you sell, right? Correct. So that might also be an efficient way to just sell and move to the
Correct. No, and that'll also get rid of a lot of the sort of red tape that's sort of involved in the entire process. So I think we've understood obviously the fee structure, the returns, and how all of this sort of happens. I think a question here from Mr. Kumar is, if once you've got that 50 lakh in your account, in one account, let's say, how does it actually work? Like, what is it that you do as the fund manager, and how is that sort of deployed in the market? Does it go in one shot? Is it a staggered way? And maybe from a broader perspective, if you have 10, 15, 100 clients, whatever it is, how do you sort of manage all of that as well, if you can shed light on that?
Right. So see, until unless the market looks volatile, or the client has given a specific instruction, we don't put it in one go. What we will try is so that deploy that money as soon as we can in the market, right? In a few days, right? Yep. Because see, the strategy is all about being allocated in the whole 50 lakh, right? So why wait for it until unless the market gives you a signal that there is a volatility coming, or if the client has given specific instructions, right? So we would try to act based on the market conditions, and the idea is to deploy the money as soon as we can, because why wait for the market?
Great. And in terms of the taxation that's involved in this entire process, so there's obviously a lot of transactions that will be happening. There will be short-term capital gains in most cases, right? So how does that work, and how is that maybe different from what people can expect in obviously mutual funds or small cases where it might be a longer term strategy? And if there is any personalization also that's involved, what level or degree of personalization is involved in this entire process is a question that Ashru is asking here.
Right. So in terms of taxation, like we said, majority of will be short term. There will be a few stocks that will go into long term as well, right? And the taxation will be similar to what you see on your small case, right? I think there won't be any difference, except when you use derivatives, right? In this strategy, if you go with the hedge version, then derivatives are taxed as business income, right? At 30%.
Yeah.
That will be the only difference. In terms of difference with mutual funds, if you hold them on to more than 1.5 years, only then it becomes capital, long-term capital gain. Otherwise, that is also short-term. And with mutual funds, I think there is an entry-exit fee as well, right? In accounting for that, the taxation or the net outgo might be quite similar, right?
No, absolutely. And in terms of, let's say, once a person has sort of decided to do this entire process of investing in PMS, etc., is there either a tax benefit or an option for people to do like joint investment? So let's say a husband and a wife, or a father and a son. Is there any of that structure? Is there any tax benefits in that? This is a question that Rekha has asked.
Yes.
I think.
So you can do joint accounts, but as per Indian laws, so you can do joint accounts with the forensic family, but as per Indian laws, the taxation will be based on the amount contributed by each participant, right? So if you both contributed 50-50,
Mhm.
then both will incur 50% of the tax, right? But if let's say one person contributed 100% and second is just a joint holder, then the taxation will only go to the first holder, right? So that's the thing. Uh,
Got it. Got it. So it's essentially it's whoever is either the primary owner of the or primary contributor, or is it's an appropriate sort of sharing of the capital that's being deployed. That is how that sort of works. In terms of the joint investment, though, how would that work? If you can shed some light on that process as well.
you can opt for a joint investment account, right? You can actually have three holders in this PMS, and then you can have three nominees as well. So if you want to start with a joint account, you can just inform us. So we will, and in your form, we'll fill up it based on two account holders. Both of them will have to sign, right?
Mhm.
That has to be done, but I think nothing too different about it. Only the taxation, like I said, would differ based on their contribution into the PMS.
Got it. Got it. And so I think there's a question here from again we've kind of answered it, but just sort of for the sake of completeness and maybe sort of more light on it. This is Mr. Anand, who's been invested with us for about 2 years in our small cases, and he sort of really appreciates how sort of we've done there. He's asking, given that we've got so many funds and small cases, etc. And the sort of team size that we have, how is it that we are able to sort of manage all of this workload, these sort of different strategies, and what is the team strength and the sort of competence that gives you the confidence to be able to sort of manage all of these funds and strategies and sort of deploy them in the market?
Right. So first thing that I would say here is that, see, it is all system driven, right? So so it reduces the number of people that is needed, right? If you using technology, then we don't need to hire 10 analysts to analyze 10 stocks, right? System has all these things inbuilt, so that enables us to be lean, right? But even with technology, you need very strong tech, right? So I don't think we have announced it, Siddharth, but we have got a CPO looking at
Correct.
we recently added a CPO, and as well as a tech team is extremely strong. On the quant side, we recently hired somebody from IIT Kanpur. On the PMS side, we are hiring an experienced person coming for the trading and reconciliation part. In terms of our people who are talking to you, you see there are so many strong people. You all know Siddharth. He's doing an amazing job looking at the whole piece. So yeah, I think our team is strong, and being tech driven, having a strong technology backend enables a lot of this and helps us be a little bit lean. But as required, right? As required, we are also organically adding people. So we don't want to be such that we just hire people and then don't know what to do with it. We try to follow an organic path and hire as needed into our team.
Correct. I think it's a lean team sort of approach and philosophy that we've sort of got here. In terms of so I think we'll take one or two more questions from the email list, and then I'll try and answer or ask you a lot of the questions that we've got from the YouTube chat as well, and then we can try and wrap up. So the question I have here from the email is it's an interesting question. So this is again Mr. Sanjay, who is asking a retirement focused question. The context of this was, I think he is on the older older age bracket right now, and he's wondering if PMS is suitable for people that are close to retirement, and if just to sort of add on to that as well, there's another question that I'd seen, which was about if PMS is relevant for, let's say, parents or senior members in their family. How should sort of people think
Right.
about it?
Right. So yeah, I think that's an interesting question. So that if you have funds that you want to allocate to equity linked strategies, right, then you can put those funds into the PMS, right? But as a retired person or as a person reaching a retirement age, you should have a healthy asset allocation, right? That's what I would say. Maintain a healthy asset allocation between your debt, equity, and the other instruments that you're going with. The equity allocation, if you want to invest, you can invest into the PMS, because like I said, it will end up being a low risk strategy, and it can give you a much more accelerated return, being active, and so all that, right? So I think it could be a good option, but I think you have to evaluate your asset allocation and see if you can fit in a PMS into that, right? That would be my answer. And if you have a question specific to you, if you want to bring on your portfolio's help, then you need our help in understanding if you should invest or not and what portion of your portfolio you can allocate to. We'll be very happy to talk to you about that.
Yeah. And in terms of, let's say, people who, I think this is a question I've seen in chat and earlier as well, where people, let's say, who have parents, right? And a lot of them might be already planning, legacy planning. The parents might be in retirement. There might be some capital that's left there, which over time might sort of get passed down to the younger generations. So what is the thought there? Should there be an approach if they can take that risk?
Yeah, so we have seen a few people do this, Siddharth, that they've opened the PMS under their parents' name and kept themselves as their nominee. And what they plan to do is that after a few months of being in the PMS, as the capital grows, they can withdraw a portion of it, which can become retirement income for the parents as well. Plus, the PMS stays under their name, is staying in their family with them as a nominee. So as and when needed, they can get access to it. So I think that is something that few of our clients have already done, and I think that's a smart plan because that helps support your family as well as give you access to this. But it will be dependent on the case and situation of different people. Do you have that risk appetite to invest into it? So we are very happy to have the discussion with everyone who wants to come in there.
Got it. No, absolutely. So I think this is probably a good time to just jump into the YouTube questions. I think we've answered majority of them, if I'm not wrong, but I will try and go through some of these with you. So the first question I can see is one from Akashdeep and another from Manu Gupta. Both are asking, one is asking about whether we anticipate any market corrections coming up in the near future. And in that context, within the PMS structure, if there are any max drawdown scenarios, let's say like the Hindenburg event report that had come out, how would we sort of handle that in the PMS context?
Right. So I think, in the PMS, especially for risk scenarios or illiquid stocks and things like that, right? We have a specialized execution team, right? So we will be acting on if let's say a news comes, right? So we can act on it within the market as well, right? So very much more quicker in handling those scenarios. In the PMS, second thing is about the market situation. So I think, if you look at the markets right now, I think there has been slight correction. The outlook remains strong. If you look at the earnings number, there is a strong hint of a sector rotation, right? There's a strong hint for us to start looking at churning the sector rotation. And I think that is what the opportunity is. I don't think there might be a very, very sharp correction coming or anything like that. But I think the sector that we'll be looking at will maybe quickly change in the next few months.
Got it. And okay, let's just go through a few more of these.
Siddharth, I think there are a lot of people here that I sort of know.
Okay, great.
Akashdeep is here. Manu Gupta is here.
Sagar is also here. I think Sagar is pretty active with us on Twitter.
Naresh Virani, I know. I know Yatin is here. Dhananjay Sate is here. So thanks a lot, guys, for coming. And we'll keep on doing more such, engagements. And, it means a lot to us that you guys attended, right?
Correct. No, absolutely. Do you want to continue? Do you want to go through some more of these questions right now?
Are there any questions about that you think that we haven't answered?
I think there's one question I think we can still maybe you can take, which is that it's a question by Mr. Himanshu, where he's asking, will dividends be auto invested or credited to the bank account? Do you think in terms of any even gains that are there in the portfolio, how would that sort of
right. So all gains, we can choose to reinvest the dividends or send it back to you. We can take that call client to client.
Mhm.
So, when we start, we'll have a discussion. Do you want them reinvested or do you want us to debit those to you?
Mhm.
Secondly, in terms of any gains that we make, those will be reinvested, right? Until unless you give us a specific instruction to, to send it back to you, we would like to reinvest that, right?
Yeah. Great. I think we have answered most of the questions. Let me just see. There's a question that just came up. Okay. Yeah, I think we've answered most of the questions in the live chat. If there's anything specific, we can obviously get back to them directly. So yeah, great session, Sonam. I think this was we've answered so many questions from not just from the chat but also from the email. Again, I think just one last question. Tax implications of both approaches for dividends. Mr. Himanshu has just asked that right now. So maybe that's the last question we can take and then wrap it up.
Right. So the tax implication, the dividends will be taxed as the dividends, right? There's no stopping that. So in the second case, we are reinvesting the dividend, but if you take the dividend in your account, then I think the dividend that you're getting from the company will be taxed anyways from SEBI, right? But only in the second case, we are reinvesting. Awesome. I think this was an amazing stream. Thanks a lot, everybody, for joining. And I hope this was insightful for you guys. And I see a lot of known faces here and incredibly grateful for them to join in. I hope we have a great run with the PMS, and any of you guys who are interested, please go and sign up to talk to us about the PMS on our website. Thanks a lot, Siddharth, for hosting this. This has been incredible.
Sure. No, thank you. Absolutely. It was a great session. I think we've answered most of the questions today. So hopefully people can reach out to us.
Yeah. So as an ending note, just have a great weekend, and I hope we have a great time investing in the next few weeks and months as well.